Welcome to Chapter 7, and in this chapter we're going to talk about accounting periods, accounting methods, and methods of depreciation. So hang on. Um, One of the things that you'll need to be aware of as we go through this as it relates specifically to depreciation is that what you may have learned about depreciation in your prior accounting courses is related to GAAP, generally accepted accounting principles. What is appropriate depreciation for federal tax purposes has, in most instances, very little to do with GAAP. So what you're going to learn in terms of depreciation for tax purposes is unlikely to be compliant with GAAP accounting. Move that down. So in terms of accounting periods, individuals for the most part use a traditional calendar year. Tax year ends on December 31st, and most partnerships, S corporations, and personal services corporations also use a calendar year. But if the partnership or the S corporation or the personal services corporation is owned by the participating individual, then they're not restricted to a calendar year. They could have a fiscal or a tax year end that is September, October, or November if that is what makes sense. And again, it says it's beyond the scope of this course. They want you to know partnerships don't pay tax as an entity. That's true. But they are pass-through entities and they still file returns. For entities that are not bound by the traditional calendar year, tax year, there is the potential that they may make a change at some point. And so if you're going to make a change from a calendar tax year that ends on December 31st to a tax year that ends at the end of some other month during the year, you're going to have to somehow get your tax year on track with that. And the way to do that is that you would declare a short tax year for 1 year. So let's say let's use the example here they've given us. So in 2017, Organic Dairy LLC decides to change from a calendar year where their tax year would end on December 31st to a tax year that instead ends on September 30th. So what they're going to do is they're going to declare a short tax year from January 1st of 2017 to 9/30 of 2017 so that they can now sync up, and going forward they will go from October 1st to September 30th. And for varieties of reasons, for certain businesses, that's what may make sense to them. So you have a customer that's going to declare a shortened tax year. They don't have short year tax tables. Our tax tables are based on an annual tax period. So what do we do in that instance to calculate the tax for the shortened tax year? We have to annualize the income that they had and basically extrapolate what that would have been to a 12-month year. So to put that in more basic terms, they actually earned $20,000 for the 9 months of the year of their short tax year. And so we divide 12 months into 9 months and multiply that by the 20,000, and that gives us what we theoretically would have earned during a 12-month tax year based on the pace we were on at that point. And then we determine what the tax would be at that annualized income. In this case, it's 15%. And so now we have the annual tax, but that income we didn't actually earn all of that income. So then now we need to determine what it was for the 9 months that we actually earned the 20,000, and that gets us to 3,000. In terms of methods of accounting, there are basically three. We have a cash method, a hybrid method, and an accrual method. The cash and the hybrid methods are not GAAP compliant. So It may be that a business is keeping their records on a cash basis or a hybrid basis because they're not producing financial statements for investors, and having two sets of books, one set of books that's kept for GAAP purposes and one set that's kept for the IRS, may be unnecessarily cumbersome, and so they just maintain one set of books. And the IRS also requires that if you have certain types of businesses that you have to elect, they will tell you what kind of accounting method that you must elect based on your type of business. For a personal services business, the IRS requires that I use a cash reporting method. So once you make a choice about whether you're going to be cash, hybrid, or accrual, if the IRS gives you that choice anyway, you got to stick with it. They don't let you flip-flop from year to year. However, there are instances where you can make that change, but you have to get the IRS blessing before you do that. Because it certainly, you could manipulate the system very easily by being a cash taxpayer one year and an accrual-based taxpayer the next year, and then vice versa. So they don't let you manipulate that. You gotta make a choice and stick with it. So if we are operating on a cash basis, what we're doing is we are recording our cash as income only when we receive it. So if we do work and we bill a customer for that work, we're not recognizing that revenue until the customer actually pays us for it. There are some limitations. We can't deduct prepaid rent or prepaid interest. So if I get to the end of the tax year and I'm sitting here on a pile of money and I think to myself, gosh, I don't want to pay tax on this profit. Maybe I'll just prepay the next year's rent instead. They don't let me take that deduction. And as I said, the IRS places certain limitations on accounting methods. So you can't be a cash basis taxpayer if you're a C corporation, if you're a partnership that has a corporation as a partner, or a tax-exempt trust with unrelated business income. The accrual method, kind of the opposite of the cash method, which is that under the accrual method, we recognize income when we're entitled to be paid for it, whether or not we actually got paid for it. And the same is true of expenses. We, as soon as we have incurred an expense, whether or not we've written the check and paid that expense gets taken against our income. So under the accrual method, for example, if we've completed a job and we've sent out a bill, then that's considered revenue even before somebody pays it. Now, I'm sure you're going, wait, that doesn't sound right. That's, what if they never pay you? And this is where taxpayers that operate on an accrual method have the ability to write off bad debts. Because they've already accounted for all of their billings as income, if somebody doesn't pay them, they can then write off a bad debt. If a cash basis taxpayer doesn't get paid, they don't get to take the bad debt write-off because they never claimed the revenue as income, because they don't do that until they actually get the green money in their hands. A hybrid method is one that utilizes a cash method for receipts and disbursements, but they use a accrual method if they have inventory and to account for their inventory. And this is probably a good point for me to stop and jump on to the next video to talk about depreciation.